To keep yourself updated, subscribe to Indigo Learn and click the bell icon and download our app OneFin to start learning on the go.
Having understood SA 520 in detail, it is now time for us to get the understanding in a summarized manner so that you get the concept even more better. So SA 520 Analytical Procedure simply talks about a procedure which is to be adopted by the auditor during the performance of his audit. The meaning of the term analytical procedure comes with the very words analytical, that is to analyze. What is the procedure all about here is that we are going to evaluate the financial information by developing certain relationship, by creating some kind of comparison between the data available with us. With this, we will be able to perform the audit more effectively and efficiently in order to understand that we have completed everything properly. This analytical procedure, in a very simple language, is establishing a relationship between the data which is available with us. As we already discussed few of the examples where we saw that you could compare some financial information, non-financial information, and we could establish a relationship. Like we spoke about the ratios, we spoke about trend analysis, we learned about the reasonableness check. So all of these will enable you to develop a relationship, and with this relationship, you will be able to understand if there is something unreasonable, if there is something which is unusual. In that case, it will derive the auditor's attention to that particular area because that would indicate a risk of material misstatement. Now, analytical procedures could be adopted, and this can be done in the multiple ways. Like we could do the comparison with the current year with the previous year's figures. We could do the comparison with the anticipated results, that is the budget, the forecast, or sometimes the expectations created by the auditor in his mind. Or you could also do the industry standards. That means you could take the information from the industry, that is a similar line of business, and you could do the comparison there. Like we had done the example of a gross profit margin, where what we did, we had taken the client's information and we compared with the similar businesses in that industry. And we saw what would be the increase or the average increase of gross margin in every kind of business. And there we could do some kind of comparison and understand whether what is reported by the client, whether it is acceptable or not acceptable. Now, when you do a comparison or when you establish relationship, you could do it both financial data or financial and non-financial data. We have studied what you mean by the comparison, but just for your proper understanding, when you talk about financial comparison with another financial information, both of this comes from the financial statement itself. Like for example, when we do the net profit ratio. So the net profit also we get it from the financial statement. The sales also we get it from the financial statement. So when you do a comparison or when you establish a relationship like this, all the data that you require will be available through the financial statements. Sometime you could develop a relationship between the financial and non-financial information. What would that be? Like the classic example was about the salary verification. So when we did the vouching of salary account or when we were checking the salaries in detail, and there the analytical procedures that we adopted, they were with regard to comparison of financial and non-financial data. What was non-financial? The number of employees. Number of employees are never given in the financial statement. So obviously that is not a financial information. We categorize it as non-financial information. So number of employees, when you are going to multiply with the average salary which is payable to them and the answer that you get, that would be also a relationship that you have created, and this you compare with the data that is available with you. Alright. So this is the comparison that is possible, financial or financial and non-financial data. So this was about understanding regarding what is meant by analytical procedure. Understand one thing very importantly, analytical procedures are not going to give you sufficient appropriate audit evidence. They are going to give you a direction to get what? Sufficient and appropriate audit evidences. That means these are going to give you an indication. It is going to drive the force of the auditor or the attention of the auditor to the areas where he could not get into in the ordinary course of audit. So the other procedures when you are adopting, you could not understand about the unreasonableness regarding some kind of suspicion, some kind of doubt or some kind of fraud risk factors. But when you perform these procedures, these will enable you to understand some kind of the elements which are present which would drive the attention of the auditor. Now, analytical procedures, the standard gives two objectives to the auditor. First, it is telling the auditor has to obtain relevant and reliable audit evidences by using the substantive audit analytical procedures. Second, it tells that you have to perform the analytical procedures at the end of the audit in order to come to a conclusion that what you have understood about the entity and what the financial statement is reporting is actually matching or not. So these are the two objectives. So for the first one, we need to understand, first of all, we need to understand why are we using the word substantive analytical procedure and the word analytical procedure. First, we need to know that why are we referring to the words substantive analytical procedures and the next one, that is analytical procedures alone. Basically what happens is, in the planning stage, when you are planning to perform these kind of relationship construction or maybe establishment of some kind of comparison, this we call it to be analytical procedures. But as a part of performance of the audit, when you are performing the substantive procedures, and if that period of time when you apply the analytical procedures, we call them to be SAP, that is substantive analytical procedures. No major difference in the meaning, but it is depending upon the location or the place where you are adopting it. If it is planning, we call it analytical. If you are using it in the performance stage, we call it to be substantive analytical procedures. That's it. Otherwise, the meaning by the very word itself does not have any change. Alright, now we need to understand analytical procedures are performed at all the three stages of audit. The first stage is about the planning, second is performing, third is concluding the audit. So while you are doing the risk assessment by understanding the entity and the environment, at that time analytical procedures will become one of your risk assessment procedures. This will enable the auditor to design the nature, timing and extent of the audit procedures to be adopted. So when you do a comparison, when you try to study the trend of the information that is available, you will be able to understand which would be the possible area of risk, where have we to concentrate more of your attention there. So this will happen at the planning stage. So at planning also we will perform what? Analytical procedures. Why? To understand how much audit procedures do we have to perform. What kind of audit procedures should we perform? So the NTE of the audit procedures. To decide that, we are going to use the analytical procedures. Then, when it comes to performance, obviously we are going to perform analytical procedures to obtain what? Sufficient appropriate audit evidences. For us to identify if there is a material misstatement. For us to come to a conclusion whether the particular items are misstated or not. This will give an understanding to the auditor whether it is required for him to perform test of details or not. For example, if one of the components, like we have used one of the components and we have performed analytical procedure on that, then if the analytical procedures give us some kind of unreasonable fluctuation, like for example purchases. So when you are checking purchases and when you created some kind of relationship or you saw the trend of the past years, you realized there is some kind of unreasonable or unusual fluctuation. So here now you realize that purchases now have to be checked in detail. So this will enable the auditor to decide how much of substantive procedures, that is test of details, he has to adopt. And finally, at the conclusion stage. Why at the conclusion stage? Very simple. We have performed the audit by adopting n number of audit procedures. So we have inspected certain documents, we have inquired about something, we have obtained external confirmations. So like that we have the conclusion ready with us. But these are all the routine course of the activities that we perform. What analytical procedures are going to help you with us? What you could not understand with the routine course of your activity, you will be able to analyze with the analytical procedures. So maybe when you were checking the debtors and when you were doing the comparison, alright, so that time when you were doing the the verification of the debtors, in the ordinary course of your audit or in the routine checking what you were doing, you saw everything was perfectly alright. But then you decided, let me perform some kind of analytical procedure. On what? Debtors. So maybe you compared the previous 3-4 years debtors and saw what was the approximate amount appearing. Or maybe you compared with the provisions and the debtors you compared. Or maybe you saw the sales and the debtors comparison you did. With that you realized there is something which is very much different in this particular year when compared to the previous years. Or maybe when the relationship that I am trying to establish is not matching, it is not giving me a sensible answer. Alright. So in this case, what happens is, you realize that when you calculated the debtors, it was all possible, it was all correct. So when you did the routine verification, everything seemed all right. But now when you did the comparison or when you established a relationship, you realized that there is something which I have to check even more in detail. So what happened? The evidence that you obtained usually while performing the audit now is contradicting with the analytical procedure you performed. So this, what you performed at the end of the audit, enabled the auditor to understand, is there any inconsistency that he could come across while performing or comparing the evidences that he obtained during the regular course and during the analytical procedures. So this comparison actually should match. If it is matching, we end up giving the opinion. But if it is not matching, then there is a doubt in the mind of auditor. My audit is still not over. I still have to do some more checking, some more additional procedures, some more investigation. So this is what the analytical procedures will help you when you perform it at the stage of conclusion as well. So we do it where? Planning, performance, as well as in the concluding stage. Now, the main part of the standard, that is the audit procedure. How do we adopt the analytical procedures? We understood what, we understood where, but now we need to understand how. How do we perform the analytical procedures? So this standard categorizes this procedure in 4 stages. The first stage it talks about is determining whether analytical procedure is actually suitable on the component that we are checking. Like for example, suppose if we are checking about the liability and we want to verify whether the organization is really having the obligation on this liability. This here, analytical procedure not useful. But suppose you want to check regarding the valuation, regarding the completeness, your analytical procedure would be useful. So we have already studied the different elements through which you would be able to understand whether analytical procedures would be suitable or not suitable. Like for example, for balance sheet items, they are not suitable. P&L account items, they are suitable. For those which are recurring in nature like sales, purchases, analytical procedures will be suitable. Non-recurring, extraordinary expenses, not suitable. Similarly, we have studied the other transactions and we have done a detailed discussion where you have come across multiple factors that we take into account for us to understand whether analytical procedure is suitable here or not suitable here. Then, second, after understanding that, we will then see whether the data that we require for comparison or for establishing the relationship, whether that data is reliable or not. And to evaluate the reliability, obviously we are going to check the source of it, from where it is coming up, right? Then we will be understanding whether it is comparable. Then we'll see whether a comparable data is available. Then we will also understand whether the controls over this data, that is the people who are maintaining the data, making the data, reviewing the data, are they all doing their work correctly or not? So whether there is adequate control over this data. If all of this is present, then we will decide to use the data which is available for the purpose of developing a relationship or for creating some kind of comparison. Third stage is that the auditor will now develop an expectation in his mind. Obviously, we are doing some comparison. Comparison with what will you do? You have the information available with the client, so that you have in hand. This you have to compare with something, right? So this expectation the auditor has to create. So as to pre-decide what is as per his professional judgment should be the amount. Now this obviously will be a calculated figure by some kind of professional judgment, some kind of calculation which the auditor will do. And he will come to an expected value. This expected value and the information that we have in hand, we will do the comparison. And in the fourth stage, after the comparison, if there is any kind of difference arising, we will then investigate it further. If there is no difference arising, or if there is a difference which is acceptable, then in that case, we will decide not to perform on that component the substantive procedure which is the test of detail. So you don't have to go again in detail, check each and every transaction, do the vouching, do all of that is not required. We could rely on the analytical procedure performed. But suppose if they don't match, then in that case, we cannot rely on that data and we need to investigate the matter in detail. So these are the procedures that you are going to adopt for the purpose of performing the AP, that is analytical procedure. Which are the 4 steps? First, we need to determine whether analytical procedure is suitable or not suitable. Second, if it is suitable, we have the corresponding data. Is the data reliable? Then the auditor will create an expectation in his mind, that is a reasonable expected amount or maybe a ratio in his mind. Fourth, the second one and the third needs to be compared. If it is matching, we are okay with it. If it does not match, we will then understand it is an indicator of a risk of material misstatement or a push to the auditor that at this area you need to perform substantive procedures, that is an additional audit procedures. Clear? So this is the audit procedure that we adopt. Now, after performing the audit procedures, we need to understand what will happen if what is expected by the auditor and what answer we get. If these are not matching, then in that case, what is the auditor supposed to do? Here now the auditor has to investigate on this matter. How will you investigate? Two possibilities. First, you will be obviously extending your nature, timing and extent of the audit procedures. You will be performing additional audit procedure. Two ways. One, you inquire with the management. The management will give you a response, and this I have given you the example of the casual laborers, where you will understand that the management is going to give you some kind of response, but the response we cannot simply rely upon. We have to perform additional audit procedure just to check what the management is telling and what they have done is actually matching or not. Correct? Second, you inquired with the management, but management is in no position to give you an answer, or the management is simply escaping from your question. So in that case also, you have to perform additional audit procedures and come to a conclusion regarding what is the reason behind this kind of unreasonable fluctuation. After all this, if you get a negative answer, obviously we'll go in for modification. If the answer is resolved, then obviously this would not be what? A kind of modification that we would require, right? So this is when things do not match. And now the second objective of the standard, which talks about analytical procedures have to be performed at the end of the audit. This I have explained you in detail, giving you an example that there is a possibility that what you are going to conclude upon and then suddenly you perform an audit procedure, which is analytical procedure. If they are not matching, then in that case it will investigate, or the auditor will have to extend his audit procedure, and he cannot conclude or cannot give an opinion. Here he will have to extend the audit procedures, increase the nature, timing and extent of the audit procedures, and only then he will be able to conclude. There is a possibility that there could be a contradicting audit evidences. There could be a possibility there is inconsistency in what you have formed or what you have obtained during the performance and what the analytical procedures are telling you. So in that way, just to come to a proper conclusion, to be able to give a reasonable assurance, this standard requires the auditor to perform the analytical procedures at the end of the audit. Now further, we need to now understand the methods or the techniques that we will be using for the purpose of applying the analytical procedures. We have four, that is, one is the trends, second is we talk about is ratio, third we talk about is reasonableness check, and fourth we talk about the modeling tools. Alright, now analytical procedures will be quite simple also in application, or you could have complex also. Alright, so based on that we have four different techniques that we could study about. First one is trend, which is quite simple to understand, where we take some years together and we do a comparison to establish some kind of relationship between them. So this kind of trend analysis when we do, if there is a sudden shift or there is a sudden downward shift or upward shifts, then we will be able to understand something unusual has happened. So this would be an indicator for the auditor to divert or to focus his attention upon. So first is trend. Second we talk about is regarding the ratio analysis, which we all must be knowing very simple, or we all study this also as a part of our syllabus itself, where we establish relationship in the form of ratios. Like there could be gross profit ratio, net profit ratio, then you have the inventory turnover ratios, where we do comparison between the financial data available with us. This will enable the auditor to understand if there is some kind of unreasonableness or if there is any unusual thing which is happening. Because ratios have to be reasonable enough, it should be satisfactory to the auditor. Then, Third we talk about is the reasonableness check. Very simple to understand. Your comparison will be done with the current year figures itself. Like for example, if suppose we have a interest bearing obligation, like a loan amount is appearing on the liability side, and we know that the rate of interest is 6%. So obviously we are going to calculate 6% of the liability, and that should be the interest amount for the period. But this is not matching. So here you realize that reasonably 6% of 10 lakh should have been so much, but it is not matching. So here you will be able to do some kind of reasonableness check, and this would enable the auditor to understand something is going wrong, or something needs to be inquired about, or there is a scope of misstatement, or there could be an indicator of fraud. So this the auditor will be able to understand by doing the reasonableness check. And then the fourth one is even more complex. When you enter into the practical life, when you start auditing in the practical scenario, you will come across these modeling tools. Like they are going to be statistical tools, they'll be using some kind of scientific logic, and through that we will do some kind of study by creating a relationship between the data available with us. So like we have simulation, we have like linear equations, we also have some kind of statistical tools. Okay, we have softwares today in place. So all of this will enable the auditor to understand what is the reason for him to enhance the audit procedures. So all of these are the techniques used by the auditor. Now, to conclude with this standard, there is one important point you need to understand. Analytical procedures, as I already discussed, will not be suitable every time. That is with respect to every component. But you need to understand, analytical procedures could also not be suitable to every organization. Like for example, if you talk about a non-profit organization, that is non-business entities, or you talk about maybe about government sectors, that is public sectors. These entities, there is very less relationship between the expenditure and the income that they have. So the relationship or the kind of connect that you have between these two amounts is not always going to make some sense, because there is going to be unreasonable shift in the amounts. There is going to be lack of a connection between these amounts. So usually you will not be able to have an interlink or develop a relationship. So when you do the audit of NPOs, or when you do the audit of public sector, basically the government entities, where there is basically minimum or you could say no correlation between the incomes and expenditures, so in that case analytical procedures would be of no use. So here you need to understand, it is important for you to know at what location it is important, or at what point you need to use the analytical procedures. So already in the standard we discussed about the components where AP may be used or not used. Like I told you, P&L account you can use, but balance sheet you usually cannot use the analytical procedures. On the similar lines, every business also analytical procedure would not be usable. Alright. So one of the examples for you to remember would be the non-business entities or the government sectors. Your analytical procedure is not an ideal procedure to be adopted by the auditor while performing his audit. So with this, we conclude SA 520 Analytical Procedures. Extremely important for the examination, purely conceptual, and this has a real practical application in your life. With this, we close SA 520. Having understood SA 520 in detail, let us now move on with solving some of the questions. With this, you will get an idea of what would be the examination questions like from the standard and how important is the standard for your examination. So let us take up now the first question for a discussion, that is, what are the considerations to be kept in mind while performing analytical procedure on the data prepared by the client? So very simple and a straightforward question, because case study kinds of questions sometimes get complicated. But these, when it comes straight, it's quite simple to understand and to write the answer. So here the question is about what are the considerations. Consideration as in where we need to concentrate on, what elements have we to concentrate on while performing analytical procedures on the data prepared by the client. So here what is understood is, if you understand the procedure properly, we had done the study of audit procedures for the purpose of performing the analytical procedure, which I had categorized into 4 parts. And I told you, first part is you have to check the suitability of AP, correct? So according to this client, if you see, they have already decided performing of the analytical procedure. That means for the particular component that they are checking, it is suitable. The analytical procedure is suitable. Second point when you talk about is regarding data, correct? Now this question is about the data which we are using. It is prepared by the client. So what are the considerations that we keep in mind for the using of this data? Correct? Now, here we are basically talking about evaluation of this data. Evaluation of data. So obviously the first one that we spoke about in evaluation was regarding source. Correct? But here sources they are telling it is prepared by the client. So it is internal. So obviously we need to be very careful here, because if the data is coming from the independent source outside the entity, then it is very much reliable. But here very clearly source is what? Within the entity. Second you will talk about is the comparability of this data. The data that is available, do you have a comparable data for it? For example, industry. Like for example, if you are taking any particular product or a service which is very specialized, which is very a unique category, then in that case to do a comparison, you would definitely require the industry standards. Okay, to understand what would be the sale, what would be the service which has been given and all. For that you would be required some kind of industry data for you to do the comparison. So second thing that we will see is there a comparable data available? Because when you are doing analytical procedure, you are comparing with something. So this is, you should check whether there is a comparable data available. Third you talk about is the nature and the relevance. Nature and relevance of data. For this, if you remember, we have done a very good example regarding budgets. Okay, now realistic budgets would be comparable budgets, or budgets which are only a dream, will those be comparable? Obviously realistic. So what happens, those budgets which are made out of some calculations, those we will consider to be relevant. Where calculations are involved and you have done a proper prediction with some reasonable estimates and everything, we call it to be a relevant information. But those which are talking about your goals as in the imaginary figures, the dream where you want to reach, those could sometime not be reachable. Correct? So those if we are available, we will not consider it to be relevant. Okay? So the nature and the relevance, very, very important for us to decide whether we can use the data or not. Correct? Here basically I would say the previous year's figures would be highly relevant and reliable. Alright, because there already happened things. So this you can compare and understand some kind of calculations that you can take up. And fourth you talk about is with regard to, see first you understood source, then comparable, then nature and relevance. Fourth, if you concentrate, they are telling you it is prepared by the client. And understand when it is prepared by the client, there is something that you have to check in detail, and that is internal control over this data. Internal control has to be strong on this data. What type of internal control? Such controls that you should have wherein there must be an ensurety of completeness of the data, accuracy of the data, validity of the data. All these three things must be there. For example, the data prepared should be properly reviewed, properly maintained, okay, properly reported, everything should be correctly done. Only then we are going to have a faith on this particular data. So here we have to have a checking of the internal control over this particular data. The internal control has to be checked. That means you have to see who has the authorization, who has entered the data, who is responsible for verification, who is doing the counter checking. All of this properly if you have ensured, only then you believe the controls over the data are good. And if the controls are good, then the internally generated data will be considered to be reliable. If you remember essay 500 where we spoke about audit evidences, there also we spoke, we could believe on the internally generated data if the internal controls are strong. Same thing here. When the data that you are going to use for the performance of analytical procedures, if they are prepared by the client, that is internally, okay, then we are going to use it or consider it to be reliable only if internal controls are strong in that particular area. Internal control with regard to what? The completeness of data, accuracy of data, validity of data, the person who is maintaining it, whether review is properly done or not, whether recording is properly done or not, all of this has to be first ensured. If yes, we will be using the data. So these are all the considerations that you keep in mind when you are going to use the data which is prepared by the client for the performance of your analytical procedures. What is that? Evaluation of data. Okay, that is you are going to evaluate the data now, where you are going to give due regard to the source, whether a comparable data is available, the nature and the relevance of that particular data which is what kind of data is that and is it relevant for comparison. And when it is prepared by the client, obviously the internal controls will play a very strong role here. So you have to check whether proper internal controls are there in place with the client. If all the conditions are present and we believe that the data is reliable enough, then we will be using the data for the purpose of performing our analytical procedures. So this is all about what are the considerations, that is the elements that you are going to focus upon. The next question that we take up for discussion is, you have been appointed as the auditor of Messrs A Limited. As a senior partner, you want to use analytical procedures in respect of room rentals as well as payroll expenses. Discuss. So this question is a case study question where you have been appointed as the auditor of the company A Limited, whereby you have decided to perform the analytical procedures on two components. One is the room rentals and the other is the payroll expenses. Okay. So we realize that these two places, it is suitable for us to perform the analytical procedures, and we have come to a conclusion now that we are performing analytical procedure on these particular items, that is room rentals, which are the expenses. Room rentals as well as payroll expenses. Now here, room rentals we will deem it to be an income. Payroll expense is obviously the expenditure. And as we already studied in analytical procedure, the entire standard, the items which are predictable over time, basically the P&L account items, on them analytical procedures obviously we can actually use. Alright. So let us talk about the first one, that is room rentals. Okay. Now how would you apply the analytical procedure? Basically you would do some kind of a study, or maybe you would do a calculation by taking the relationship between financial and non-financial data. So you will establish a relationship. The financial data would be the room rentals. Okay. So you would have room rentals, assume some X rupees. This with the number of rooms, that is non-financial data, you could take number of rooms, and obviously this data will be available. Okay. And one very important thing is the vacancy rate also. Sometimes the rooms are vacated. Okay, that means if the occupancy is not full, it is not a seasonal time, or maybe it is not the ideal time for travel and all, then this vacancy rate is also going to be there. So taking into account the room tariff rates, number of rooms that you have, and obviously the vacancy into consideration, it could be the percentage basis. So based on that, you are going, this will usually be the percentages. Keeping that in mind, you will come to a figure. So this is the expected figure calculated by the auditor. You have a figure appearing in the P&L statement. Suppose here it has been given as Y amount. So obviously you will do the comparison with what? This and this. Correct? So you could perform the analytical procedures on the room rentals, but according to me, this would be a persuasive audit evidence. Persuasive audit evidence. And definitely if you have done the proper verification of the room tariffs, of the number of rooms which are present, the vacancy rate has been calculated correctly by you, okay, then in that case, this would definitely give a result to a persuasive audit evidence, which will enable the auditor to decide that on this particular component, you don't have to do all the detailing of test of details. You don't have to do the entire verification by performing the test of details. Alright. So just for a quick recap for you to understand, we are checking the room rentals. And for the room rentals, we have taken up two financial data, one financial data, one non-financial data. Financial data is the tariff rate, that is the room rentals, the cost that you call it, and the number of rooms. But obviously, number of rooms throughout the year will not be fully occupied if you take into consideration this assumption. So obviously, you have to take into consideration the occupancy rate, or in the contradiction we can talk about is the vacancy rates. So these will be usually in the percentages. So when you take the tariff rate, have a proper verification done, see that you take the approximate and the correct rate. Number of rooms should be properly verified by you, proper calculation of this, and vacancy rate also should be properly calculated. If all these three are properly calculated and well clear figures are in your hand, then when you do the comparison, you will get an expected amount. Correct? This expected amount, you will do the comparison with the amount which is available with the client in their financial statements. When you establish a relationship between them or do the comparison here, you will be able to understand whether it is reasonable or not. If it is reasonable, then you would be considering it to be a persuasive audit evidence, and you will come to a conclusion that there is no need for us to perform test of details on the room rentals. On the contrary, if you find it to be unreasonable, there is no matching happening properly, then you will go in for what? A detailed checking, which we say test of details would be required. Correct? So this is with respect to what? The room rentals. The next that they're talking with us is about the payroll expenses. Payroll expenses in a simple language to understand is about the salary. Correct? Payroll is nothing but employees on your payroll and the salary that you pay. Correct? So here also we take into account financial and non-financial data. Where financial we are going to consider the pay, assuming fixed pay is there for every employee, into the number of employees, which is the non-financial data, employees that we have. We do the calculation and we come to an approximate figure. This we again compare with the P&L account items. If it is matching, we are okay with it, and we will say no need for test of details. But if you find it to be unreasonable, unusual fluctuation, then yes, we will extend the NTE. Correct? So here if you understand properly, both these places, this auditor, that is we in this example, we have chosen to perform the analytical procedure. So basically room rentals, very obviously you can perform. Salary, which is the payroll cost, on that also you can perform. Understand, data that you are using, first have the evaluation of that data. That is most important. If the evaluation of the data is happened correctly and then you apply the analytical procedure, then the result what you get, we could call it to be reasonable or acceptable. Otherwise, analytical procedures will absolutely serve no purpose to the auditor. So in both these cases where we have come across the calculations done by us, where we decided to eliminate the test of details, it is very much valid, but a condition applied to it that all the components, whether financial or non-financial, which are going to take into consideration, should be individually verified by you properly. If you guarantee the proper verification of those data which you are using, then in that case, using analytical procedure for the room rental and salary, which are both the P&L account items, would be considered to be correct. Alright. So here if you look at the question is very clearly telling that this auditor wants to use analytical procedure in case of room rentals as well as payroll expenses. We'll assume it to be in hotel. Okay. So room rentals and payroll expenses. So here we could give an answer that yes, it is possible for the auditor. However, he has to check the data which is available. If this data is reliable enough, then in that case, we can move on applying the analytical procedures on both the items given here, that is the room rentals and the salary, which is the payroll cost. The next question that we take up is, in case of DEF Limited, the auditor had made use of certain analytical procedures with regard to certain key data in the statement of P&L. The results obtained showed inconsistencies with other relevant information. State the course of action that the auditor would take to ensure that the risk of material misstatement would be contained to a low level fixed as per the materiality level. So very simple question. This is with respect to what we studied as a part of investigating. So when we spoke about investigating matter of SA 520, we came across the situation. If you remember the objective of SA 520, where I told you that the second objective which the standard is highlighting is with respect to the performance of the analytical procedure at the end of the audit, in order to assist the auditor to understand that what he is concluding or what he has understood about the entity and what evidences he has obtained, they should all coincide. That means whatever he has understood and what evidences he is having, the conclusion that he is drawing should actually be matching. And that is the reason that we are performing the analytical procedures also at the time of conclusion. Because analytical procedure is going to be a corroborative audit evidence, it should be in the supporting to the other evidences that you obtained. So during the course of audit on the sales, purchases, salary, rent, maybe interest, maybe commission, maybe any other information that you have, when you do the vouching and verification, you will come to a conclusion whether they are misstated or they are not misstated. But when you perform analytical procedures on them at the end, usually what should be the answer? That they should provide a corroborative evidence That means yes, what they are telling, and when you perform the analytical procedure, they should actually match. That means analytical procedures also should give you that kind of evidence which is telling you that there is nothing which is, an indicator of risk of material misstatement. That means they are reasonably free from the material misstatement. That is what it has to be. But suppose during the course of audit, you have understood that these elements do not have a material misstatement. But when you perform the analytical procedure, when you did some kind of comparison, you came across something unusual which you have not identified during the course of your audit. In this case, what happened? You realized that there has been an inconsistency with the evidences and the analytical procedure answers that you have got. Correct? So in this case, how are you going to take the further steps? That is the question telling you or asking you. Alright? Now let us read the question once again in detail so that you get the crux of what it is questioning you. So we are doing the audit of DEF Limited, and this auditor, that is we, have already performed certain analytical procedures. So maybe we have done some ratio analysis, some trends, we have done some reasonableness check. So like that we have performed some audit procedures. With regard to certain key data in the statement of P&L. So key data could be anything. You could have taken salary, you could have taken sales, purchases, maybe depreciation. Okay, any key element of the P&L account you could take for applying analytical procedure. The result obtained showed inconsistency with the other relevant information. That means when you already checked this during the course of your regular audit, you did not find any kind of misstatement. So according to you, they are reasonably correct. But after you performed the analytical procedures on them, you came across something which you could not identify. So now you have come to a position where you understood there is inconsistency, that any of the element, maybe let us take the example of salary, where you realized there is something that the auditor has to check now because it has some kind of inconsistency with the evidence that you have obtained in the routine course. Now, state the course of action that the auditor should take to ensure that the risk of material misstatement would be contained to a low level as per the materiality level. So instead of telling this, they could also tell eliminated. Not obviously, audit risk cannot be brought to zero, so we are going to consider it to be low level. But obviously, when we study, we are going to say we are trying to eliminate the possibility of a material misstatement. Okay? Now, understand here what we will do. Assume when I checked all the salary expenses, maybe when I have checked the acknowledgements, when I checked the bank's statement, when I checked the employees' offer letters for cross verification, in all those places I have not come across anything which is an indicator of the misstatement. But then I did some kind of a reasonableness check where I simply took the number of employees and I multiplied with the average pay. This comparison when I did with the amount of salary, then I realized there is something which is not matching. There is something which is unreasonable. So the evidences that I obtained while checking salary as a part of the documentary evidences is now inconsistent with the analytical procedure that I performed. So in this case, what will the auditor do? Obviously, here the auditor, since he has come across an element which is indicating a risk of material misstatement, he will now rethink or redesign the nature, timing and extent of his audit procedures. So he has to now investigate on this matter. Therefore, he will now extend